Hello guys, welcome to i-tutor Academy. In today's session, we will start with the subsection of 7, Unit 3, MMBG 004, preparing a trading and profit and loss account. Having understood the basic concept of income and expense as well as revenue recognition, we shall now prepare a trading and profit and loss account. It is also commonly referred to as profit and loss account or income statement or statement of operations. It is a final account that shows the summary of all revenue and expense recognized during the accounting period, the net effect of which is reflected in the profit earned or loss incurred. Thus, revenue minus expenses is equal to profit or loss. Some fundamental rules must be clear while preparing a trading and profit and loss account. The P&L, that is profit and loss account, has two sides, debit and credit. We must debit all expenses and losses and credit all income and gains. Debit balance are shown on the left hand side, and credit balance on the right hand side. Income and expense must related to the current accounting period. The balance of expenses, incomes, losses and gains are taken from the trial balance. However, there might be some omissions or corrections in the trial balance which need to be adjusted in the P&L account if they related to current year. Trading account represent the gross profit or loss from the core business operation. Profit and loss account represent the net income or loss from all the operating and non-operating activities of the business entity. So here is one illustration based on the subject, and let us illustrate the preparing of profit and loss prepared from the trial balance with the help of an example. So you just go through the example, it will be more clear about this topic. Okay, and activity also there, you can try this activity based on the example. And summarizing the income statement, P&L account. Profit and loss account is one of the three final account generated by the business at the end of an accounting period. It shows the gross and net profit or losses generated by the business in an accounting period. Therefore, it is a measure of management's ability to generate income from assets. P&L account is divided into two sections. Trading account reflected the earning from core business operations in the gross profit or gross loss, whereas the profit and loss account summarizes all the operating and non-operating revenue and expenses in the net profit or loss. The revenue and expenses recorded in a profit and loss account belong to the current accounting period. P&L account is also commonly referred to as the statement of profit and loss, income statement, statement of operations, etc. Its preparation is based on the accounting principle of revenue recognition, matching and accrual the net profit or loss sustained by the business as calculated by the P&L account, increase or decrease the retained earning in the balance sheet respectively. So next is balance sheet. The balance sheet, as this name suggested, in the summary of the balance of the various asset, liability and capital account of a business entity as on a particular date. In simple terms, it is a summary of things owned by the entity as well as the claims against those things represented in monetary terms as on the specific date. In brief, the various aspects of balance sheet can be put as follows. A balance sheet is a financial statement prepared from the point of view of a business entity, firm or company, and not from the point of view of its owners, investors, directors, creditors, etc. A balance sheet is a statement and not an account. It is a statement showing the financial position of the business entity on a specific date. It is a historical report showing the cumulative effect of past transactions. A balance sheet always relates to a particular point of time or date and not a period. A balance sheet depicts the resource owned, that is asset, on one side and obligations, liabilities of a business entity on the other side. All items on a balance sheet are represented in terms of monetary value. The total of both sides on a balance sheet are always equal. Let us understand the concept of balance sheet with the example. So here is one example. You just go through your IGNOU materials, so it will be more clear about balance sheet. And next is dual aspect concept. Let us take a step further in the previous example. Okay, there is one example was there, you just go through it, then you can more easily identify the concept of dual aspect concept. Asset is equal to liability plus owners equity. So you just go through some small examples, then it will be easy for you to explanation. The above accounting equation indicate that the entity asset have to be equal to the sum of the liability and owner's equity. This equation is considered to be foundation of double entry system of accounting. It ensures that every entry made on the debit side has a corresponding entry made on the credit side and vice versa. Hence, the double entry made will automatically balance the accounting equation to sum up it. An increase in asset is followed by an increase in liability and or equity and vice versa. A decrease in asset is followed by a decrease in liability and or equity and vice versa. An increase in an asset is followed by a decrease in another asset and vice versa. An increase in liability is followed by a decrease is in another liability and vice versa. So let us consider the following series of example to explain this concept further. Okay, so here is again the same example. It's explain the its concept and activity also there. You just go through your IGNOU material and try to answer this activity also. And balance sheet contents and classifications. Having understood the basic concept and function of balance sheet, let us now study the contents of a balance sheet. We have seen that every transaction affects the financial statement of a business, but it is not feasible to draw up the financial statement after every transaction. Thus, financial statements such as balance sheet, P&L and cash flow statement are prepared at the end of a specified period, usually a year. This specified period is referred to as the accounting period or a financial year. As already discussed, the balance sheet prepared at the end of the accounting period reflects upon the position of the entity's asset, liabilities, and capital account on that specific period or date. The balance sheet is further subgrouped in order to facilitate a more meaningful and convenient analysis as shown in the following illustration. So here is balance sheet of the same, and you just go through this example, and it will be more easy to uh, grasp the aspect. Okay, assets are so resources of economic value that a business entity owns with the expectation that they will provide future economic benefit to the business. Okay, and liability are obligation the business owes to outsiders. They are also divided into current liability and non-current liability. Current liabilities are obligation that are scheduled to be paid within a span of 12 months. And owner's equity, a owner's equity represents the owner's residual interest in the asset of a company net of its liability. Owner's equity is equal to assets minus liabilities. It is also referred to as net worth of the business. In other words, owner's equity is everything that is left from the asset after paying all the liabilities. It consists of the capital contributed by owners and retained earning of the business. And current asset, a current asset is an item on an equities balance sheet that is either cash, cash equivalents, or an asset which can be normally converted into cash within the operating cycle of a business or within 1 year, whichever is shorter. An operating cycle is the duration of time it takes for a business or to convert its inventory into cash. It includes the time taken in acquiring inventory, converting inventory to sales, and then recovering cash from trade receivable. And the common example of current asset are listed below in order of their relative liquidity. Cash and cash equivalents, short-term investment, that is marketable securities, accounts receivable, inventory, prepaid expenses. Cash and cash equivalents. Cash refers to the currency, checks, or any other documents that circulates as cash. It includes the cash kept in the cash chest of business and also the deposit made in current account with the banks. Further, cash equivalents are the highly liquid investments that are readily convertible into cash and are subject to insignificant risk of change in price. Example include cash and paper money, treasury bill, money market funds, etc. Cash and cash equivalents are the most liquid form of current asset available for a firm's day-to-day operations. And short-term investment, it is advisable to invest excess cash held by a firm to generate additional income. It may be invested in financial instrument that can be quickly converted into cash like equity shares, debentures, and government securities. And account receivable, usually a business entity sells its goods and services both in cash as well as on credit. Accounts receivable refers to the balance of money due to business entity for the sales made on credit to its customers. It is also denoted as sundry debtors in the balance sheet. It represents the amount arising out of normal business transactions such as credit sales, and the credit period usually ranges from few days to months. In most situations, these accounts are unsecured and have only the personal security of the customer. In some cases, customers default and the payment may not be realized. These defaults in payment by debtors are called bad debt. That is, bad debt are recorded as an expense in the profit and loss account. And next is inventory. Inventory generally consists of raw material required to manufacture the product and finished goods at various stages of completion, work in progress, and finished goods ready for sale. Apart from these, there may be inventory of stores and supplies. And prepaid expenses. Prepaid expenses are items which are usually paid in advance, such as rent, taxes, insurance, etc. For example, if rent for 2 months of the office building is paid in advance, then the business acquires a right to occupy the building for 2 months. And that is prepaid expenses. And fixed asset is there. Fixed asset are tangible long term asset used in the business that are of a relatively fixed nature. These include building and land, furniture, equipment, machinery, etc. Fixed assets are not expected to be consumed or converted into cash within a year. Instead, they are used in running business operations to generate income. And such a decrease in cost is referred to as the depreciation in accounting. The conceptual basis could be clarified with an example. And there is written down value also. The most commonly used methods are straight line and written down values. Okay, and you just go through the example. It will be more easy to understand the subject. Okay, intangible asset are the resources or things of value that have no physical appearance and are valuable to the business in the long run. And some intangible asset might have an indefinite life too, such as goodwill. Goodwill arises when business fame acquires another business fame and the cost of its purchase is higher than the fair market value of the business. And hence, the excess purchase price paid over the fair market value of the acquired business fame is termed as goodwill. When the intangible asset has an indeterminate life, it is not amortized, but it is periodically tested to see if the recorded cost of the asset has been impaired. And fictitious asset, as the name suggested, fictitious asset are not actually asset, yet they appear in the asset side simply because of a debit balance in a particular account has not been completely written off. And current liability are the short term financial obligation of a business entity which are due for payment within the operating cycle of the business or within 1 year, whichever is less. These are usually incurred when the raw material or services are purchased on credit. Current liability are settled either by using current asset or by the creation of other current liabilities. The ratio of current asset to current liability is known as current ratio or liquid ratio, and it helps in determining whether a business entity is able to pay all its short-term debts. And accounts payable represent the sum of money owned by a business entity to its suppliers or creditors, usually for the goods or services supplied on credit. These are the monetary obligation of an organization arising in a short run. Generally, such a claims are unsecured. And outstanding expenses. Outstanding refers to due but not paid. These expenses become due during the current accounting and hence are shown as an expenses in the profit and loss account. However, as the actual cash payment of these expenses are yet to be done, they are also shown as a current liability in the balance sheet. Income received in advance, it is amount received in the current account period but which is due to be received in the next accounting period. Since it is not recognized as income in the current accounting period, it is treated as a current liability in the balance sheet until it becomes due. And provisions for taxes, every business entity is liable to pay taxes to the government on its earnings. However, taxes are not necessary paid on the end date of an accounting period. The date for payment of taxes usually lies in the next financial year. Hence, a business entity creates a provision for current financial year taxes to be paid. Next is long-term liability or non-current liability. Long-term liability are the financial obligation of which the fame which are not paid off in the current operating cycle or current accounting period. These liabilities do not become due for payment within 1 year. The financial obligation in case of long-term debt lasts for more than a year. They are classified as secured loans or unsecured loans. And contingent liabilities, the literally meaning of term contingent is subject to chance. Contingent liability are those liabilities that may arise depending on an uncertain future events. Until then, both the occurrences and amount of liability are uncertain. If the event happens, there is a liability. Otherwise, there is no liability at all. Therefore, they are not recorded in the balance sheet but are required to be disclosed as footnotes to the balance sheet to provide a fair view about the affairs of the business to the users. And contingent liability can be defined as possible obligation that arises from past events and the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future event not wholly with the control of the enterprises. And a capital or owner's equity. Ordinarily, in a small proprietorship fame, the owner's equity constitutes the capital contributed by the owners into the business. However, in case of a company, the owner's equity section of the balance sheet is divided into two parts. One is share capital representing contributed capital, and the second is reserves and surplus representing retained earning. The share capital is the capital contribution by the shareholders or owners. In case of the money, share capital is the joint stock predetermined at the time of registration, which is known as the authorized capital. The authorized capital need not all be raised at one time. That part of authorized capital which is issued for subscription by the company is referred to as the issue capital. And equity share capital and preference share capital. Equity share capital is also called as the residual capital, as the equity shareholders have the residual claim against asset of the company at the time of liquidation after all the claim of creditors and preference shareholders have been met. And ordinarily, shares or equity shares have no preferential right with respect to either payment, repayment of capital or distribution of profit. And reserves and surplus. Reserves and surplus are the accumulated earning of a business entity retained over a period of time and not distributed among shareholders as dividends. And activity also based on that. You just try to answer the activities, it will more help you. And summarizing the position statement, that is balance sheet. After learning about balance sheet, we observe that it is one of the most crucial financial statement as it reflects the financial position of the business and aids decision making process of shareholders. It is a periodic summary of asset, liability and owners capital as of a particular point in time. This statement in itself does not reveal anything about the details of operation of the business. However, a comparison of two balance sheets could reveal the changes in financial position of the business. A holistic understand of the operation of the business would require an analysis of two other statements, that is income statement and profit and loss and cash flow statement. And next is relationship between income statement and position statement. The income statement mainly determines four elements, namely revenue, expense, and income or loss. And profit is reported when revenue exceeds expenses, where when expenses exceed revenue, loss is booked. It should be note that the revenue and expenses must related to be specific amount period, and there is equation also, asset is equal to liabilities plus owner's equity, and owner's equity is equal to share capital plus retained earnings. Okay, and a summary of this unit is here. The process of accounting aim at providing the financial information about the business entity to the users with the help of financial statement. Financial statement are the formal end reports that summarize the business operations and transactions conducted in the financial year. These statements are prepared as per the accounting principles to generate systematic and consistent results. They are useful indicators of the financial health of a business entity at a particular point of time. It is vital to present the financial statements in a proper form with the suitable content so that the shareholders and the other users of financial statement can easily understand and use them in their economic decision in a meaningful way. There are three main financial statement of a business entity: the balance sheet, that is position statement, as at the end of accounting period; the statement of profit and loss, that is income statement, and the cash flow statement. And keywords also related from this unit, and balance sheet. If you feel any words are difficult, you just refer this section. Okay, it will help you. And self assessment questions also there. And first one is difference between expenditure and the expense. Give suitable example and explain the revenue recognition concept with the help of example. And in this chapter you just try to learn with the example. It will be more easy because some words are everything is about accounting, financial statement, balance sheet. So may you feel it will difficult, but it is very easy. You just try to understand with the examples. Okay, and write a short notes. You just prepare this short note side because most of the question maybe from this chapter are short note based. Operating profit, earning before interest and tax, contingent liability, retained earning, depreciation. The fixed next question is, the fixed assets are physical asset that provide operating capacity for a number of accounting periods. Explain with the help of suitable example. Do all fixed asset, that is depreciation. And what are bad debt? What is the way to deal with the problem of expected bad debt in accounting? And here also given below is the summarized profit and loss account of Athens Limited for 3 consecutive accounting period. You are required to fill the missing information. Okay, this is year 1, year 2, year 3. Particulars are also there: gross profit, operating profit, net profit before tax, and net profit after tax. And 7th question also based on that, and 8th question also based on the activity. Okay, so you just go through answers also here. Okay, it will be more easy. Some chapters are not providing the answers, but here is our answers about this chapter. So try to answer these questions, and if you feel some difficulties between, you just contact our contact number. Also you can comment it on our comment box also. And for more videos from MBA IGNOU courses, you just do share, like, and subscribe our channel. Thank you so much.
i-tutor ES presents IGNOU MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students, online and flexible sessions. For more details, contact 62382 1788.